Hello and welcome back to our channel. My name is Willy and today we're going to look at what is divergence and how it could actually help us in terms of our trading. So get yourself comfortable at home, grab your pen and paper ready. Let's dive in with Willy. Now, divergence actually is an opportunity for us, or it also provides us with confirmation. But how does it actually work? Divergence itself is a very peculiar signal because we can utilize it in so many ways. But two ways that we're going to utilize it that in terms of trading is that we can actually treat divergence signal as an opportunity for us to actually put in order and maybe or hopefully we can earn profit from that. Now, another way to use divergence as a confirmation is whereby we can use divergence to confirm whether or not this pair or this asset's price is going to go up or go down extensively. So let's say, for example, we are trading Apple share price. So Apple share price right now is currently going upwards. However, if a divergence signal actually occurs on the Apple share price, this may mean that it might actually come back down. So this divergence itself can actually provide us with confirmation on top of other tools that we use during our analysis. So right now, we're going to dive in deeper to look at some basics about divergence. In terms of divergence itself, it is actually bringing the meaning of to diverge, which is to be different. It could also mean discrepancy in terms of the price of the asset and also the indicator, and it could also indicate disparity. So a divergence during trading is actually a signal for reversal to happen. Now, a short recap is that a reversal is whereby the price of an asset would undergo a change in its direction for short term only. That is what we call as reversal. So we have two examples here. One is called the rebound and another one is called the retracement. So basically a rebound occurs when its long-term trend direction is actually in a downtrend, but then suddenly it went back up again, but only for short term. So this is actually a rebound scenario. Whereas for retracement, it would be the opposite of rebound, whereby the long-term trend for this would be an uptrend, but then suddenly it undergoes sudden change in its direction and it come back down for short term. So these two cases, in terms of its movement for short term, is actually known as reversal, but it has two different names for each of it, depending on the long-term trend direction. So if the long-term trend direction is actually a downtrend, and when you undergo a retracement or a reversal, then it's actually known as a rebound, and vice versa. So right now, in terms of divergence, what we need to understand is that divergence is actually telling us that the price of an asset may change, but only temporarily. So this is actually a signal for us to get profit for short term. Now, like I've just mentioned in the previous part, reversal may actually indicate a sudden change in its direction of the asset price, but only temporarily. But however, there are question that arises is that whether or not a divergence will actually be temporary or it's going to lead to a permanent change in its direction. At times, throughout my experience in trading and also while using divergence signals, divergence actually indicates temporary reversal. But there are on rare occasions whereby the reversal is prolonged. And when it's prolonged, it may also lead to a major change in its trend direction. So let's say, for example, the price of this asset is actually going downwards. And then suddenly, divergence came in and it starts to come back up. So sometimes there are certain scenarios whereby maybe an economic data or maybe investor sentiment may actually changes the way it moves after that. And it may lead to a permanent change in its trend direction thereafter. But what I could say is that divergence is actually just a signal. It doesn't really warrant for, permanent changes in its price or temporary changes or whatnot. It actually provides us with this confirmation whereby the change is gonna happen soon, but it's not to be, it's not to be 100% sure whether it's gonna happen or not. It is just a signal itself. However, we can actually use this signal to get our confirmation when we do our analysis, and as well as a trading opportunity for us to earn more profits from that. Now, since I've talked so much about what is divergence and how it may actually look like, but without an illustration, so right now, we're going to identify a divergence on how it's going to look like and a bit of its utilization. So how do we actually identify a divergence is that it occurs when the asset's price trend and also the indicator's trend moves the opposite way. Now, I'm going to show later with my diagram itself. Now, a few popular indicator that is actually used to indicate or to identify divergence is either RSI, which is also known as the Relative Strength Index, Stochastic Oscillator, or MACD. I mean, there may be other indicators that actually can be used to identify a divergence, but these are the three most popular ones because they are easy to read and they are easily accessible. So right now, we're going to look at how do we actually identify a divergence. Now, first off, we need to know that there's two types of divergence. One is called the bullish divergence, and another one is called the bearish divergence. Just like its name, bullish divergence means that we expect something to go back up because the word bullish is there. So like it says, we're going to look over here. At this first box is actually the asset price. So we just call it the price of the instrument. And then on this yellow box here, we just, going to take this as the window for the indicator itself. Either RSI, stochastic, or MACD, or whatnot. Any indicator that actually can be used to determine or to identify a divergence. So let's say in a scenario, you were looking at the asset price for, let's say, gold. And you notice that gold price is actually going downwards. You can actually see that it's going downwards is because the lows is actually getting lower, whereas the highs is also getting lower. So this is actually a downtrend. However, when you refer to the indicator, let's say for this case, we're going to use RSI. And you saw that the RSI is actually going upwards because it's actually getting higher and higher. Now, in a normal scenario, whenever the asset price is going downwards, we also expect the same for the indicator. Most of the time, it's going to be like that. However, there are certain times whereby the asset price is actually going downwards, but then the indicator is actually going upwards. So this is what we know as the bullish divergence. So a bullish divergence is whereby the price of the asset may go up further in the future. If so, it happens. So this actually tells us to put a buy order on this asset itself. So one real life example we can see is over here. So this is a GBP JPY in 4-hourly chart, I would say, or daily. I think it's daily. Yep, this is a daily chart. So as you can see here, this is GBP JPY, and we're going to look at this trend here. Let me put a drawing. So we're going to look at this trend here. So from this trend here itself, we can actually see that the price of GBP JPY is actually going downwards because you can see that the lows is actually getting lower, whereas the highs as well is actually getting lower. But when we look at the indicator itself, you can actually see that the indicator indicate otherwise. When we look at the indicator, it's actually getting higher and higher because you can see here the lows is actually getting higher. So this means that there's a discrepancy in terms of the indicator trend and also the asset prices trend. So in this case, we have actually identified a divergence. This is actually a bullish divergence itself. So let's say if we saw this kind of signal, we enter into the market, we will anticipate it to go up. So let's say if the divergence does actually is accurate or are really accurate, then you may see some price movements just like this, whereby after it went down further into lower level, it would just rebound back up substantially. So this is why I would say that divergence is one of the popular signals that is being utilized by traders around the world, because sometimes it may bring quite significant amount of profit. Now, on the other hand, it's better known as the bearish divergence. So in terms of its name, bearish means we anticipate something to come back down. So let's look at here is that the asset price is actually going higher and higher. But then when you look at the indicator, it is actually going lower and lower because the high is actually getting lower for the indicator itself. So normally what we expect to see is that when the asset price is going up, indicator will also do the same. But however, there's a discrepancy here. Both is moving at different direction. So this means that we have actually identified a bearish divergence. So in the future, we may expect the price of the asset to come back down. And this is actually a signal for us to do a sell order. So in terms of the real world scenario, we're going to look back into GBP/JPY. And yes, this is the H4 or 4-hourly chart of GBP/JPY. So we're going to look at this part here, whereby you can actually see clearly that GBP/JPY is actually trading in the uptrend. Because when you look at the highs, it's actually getting higher. But then when we actually look into the indicator itself, right over here, you can actually see that the indicator is getting lower and lower. So the price of the asset is in the uptrend, but then the indicator itself is actually in a downtrend. So this actually foreshadows that the price of GBP/JPY might come back down. So eventually it did come back down and it has dropped quite significantly. So let's say if we enter around this area here after the signal has been formed and confirmed, you may actually earn quite substantial amount of profits from trading through divergence itself. So this is actually what we refer to when we are looking into divergence. There are also divergences in terms of hidden ones, but we are not going to touch that today as it is being reserved for our next video. So this is how we actually look into the more common divergence, which is the bullish and also bearish divergence. So that's all on today's video about divergence. Don't forget to subscribe us for more videos just like this.